25% yield? Too good to be true? Today I'm doing a deep dive into HHIS, an ETF that is turning heads for its jaw-dropping monster yield of more than 25%. While HHIS promises big returns, it also carries a significant amount of risk, and we're going to unpack all that, so stick around. I want to break down how it works, the risks involved, whether it could have a place in your portfolio or not, or if it's just a gamble gone way too far. First up, what is HHIS? As a CPA, I'm constantly analyzing different market strategies, and honestly, this one in particular, I find very fascinating. HHIS is the Harvest Diversified High Income Shares ETF. Essentially, this is a one-ticket strategy that bundles up multiple Harvest single stock covered call ETFs, often focusing on the more volatile growth-oriented names, and I'm going to uncover those names a little bit later in this video. On top of all that, being a multi-layered ETF, focusing on single stock ETFs, focusing on covered calls, focusing on volatile names, focusing on growth-oriented names, on top of all that, it's going to layer on a 25% leverage, which is what helps amplify its positions. In theory, it's this aggressive structure that's purposely designed to deliver on that monster yield. So how does it all work? How does it actually generate that monster income and monster yield? Well, there's two mechanisms at play, the covered calls and of course the 25% leverage we just talked about. So here's how HHIS works in a nutshell. It sells call options on the shares held by the underlying ETFs, which help it grab that premium income. It then uses leverage to amplify the gains and, you guessed it, the potential risks as well. It's currently targeting to pay a consistent monthly distribution of 25 cents per unit. And with today's stock price of around $11.46 per share, that's how they're able to advertise the monster yield of more than 25%. Let me show you the math behind this. All right, so here we have my handy dandy yield calculator. So what we know is that it pays a distribution of 25 cents per share. So punch that in right there. And it pays that on a monthly basis, and there's 12 months in a year. That's 12. So we know that on an average annual distribution, 12 times 25 cents, you're going to get about $3 per year. The current price is around $11.46. Doing the math, 3 divided by 11.46, you get 26% yield, and that's how they're able to advertise such a monster yield. That's the math. Let's take a quick look inside to see how this ETF actually works. This is an ETF of ETFs. What that means is that the HHIS ETF actually holds other Harvest covered call ETFs. And each of those ETFs hold one single company. How this differs from traditional ETFs is that the ETF will hold hundreds of stocks or even thousands of stocks if you've been following the channel and some of the ETFs that I've covered. For example, its holdings will include other ETFs from Harvest like those focused on AMD, MicroStrategy, Eli Lilly, or even Costco. It's through these underlying ETFs, it also gets significant exposure to the tech titans like Netflix and Microsoft. This structure means that you're getting diversification across multiple covered call strategies all at once because of this one ticket solution. This also means there's a potential for fee layering because there is no free lunch. Get what you pay for. And with HHIS, the mix is very heavy on tech, biotech, fintech, and all these sectors are specifically known for their volatility. But that's why you get that monster yield. It's there to cushion that risk. And here's the kicker. Here's why investors are flocking en masse to this ETF because of that monthly 25 cents distribution per unit. It's only been around for 5 months. It started around January 2025. So as of this recording, we've only seen 5 months of track record. And in each of those 5 months, it has consistently paid out that 25 cents per unit. But here's my $1 million question to you, and we're going to talk about this. Can those covered call premiums and dividends sustain that monster yield over time? Some experts say yes. Other experts are quick to warn out that this is a ticking time bomb. Those optimistic about that yield quickly point out that because of the consistent inflow of those call option premiums, it may be able to sustain that yield over time. However, the counter argument is that severe market downturns can quickly erode the fund's capital beyond what the premiums can cover, potentially forcing a distribution cut or relying heavily on return of capital, also known as ROC. Now, there is one other ETF on the market that we can take a look at because when it came out, it promised a 12-14% yield. What happened if we look at this as a guidance? This initially marketed an 18-cent distribution. However, if you look at this right now, this particular ETF has been cutting its dividend since time went on. So if we take a look at this ETF that also came out and made a big splash about a monster yield, monster distribution, this ETF that launched back in 2023 also had a big claim about a distribution and a big yield. What happened was this 18.5 cents of initial distribution, after 2 months, it was cut to 18 cents. Then after a few months, it was cut to less than 18 cents. Then at 17.75, then to 17.45, 17.30, 17.10, 16.95. Hopefully you get an idea of where this is going. Fast forward to today, 16.85, it came up slightly, but now we're at 16.5 cents. In a span of 2 years, it has gone from 18.5 cents to 16.5 cents. The point is to show you that don't just blindly fall in love with a yield or high distribution. When things get tough, the fund has to cut its distribution to maintain itself. There's no magic distribution. You can't make money out of thin air. If the math isn't mathing, this is the result. As a CPA, it's critical that I explain you this. Return of capital isn't true yield from earnings. It's just the fund giving you a portion of your invested money back into your pocket. Let me give you another example. What if I told you I could give you a 100% return in only 4 months? All you have to do is just invest $100. And I give you $25 every single month. Well, what I'm really doing is I'm taking a portion of the money you gave me, the $100, and I'm just giving you $25 out of that. In 4 months, technically, you have earned a 100% return. But now I don't have any capital to give you, and that's all. So in theory, you made a 100% return, but you just got your money back. So in 4 months, you really didn't get anything because your capital was just given back to you. And because ROC is effectively you getting your money back, it's not taxed like other dividends are when you receive that income. Because again, it's your money coming back into your pocket. What happens with ROC is that it reduces your cost base. So when you ultimately sell that stock or ETF, you will end up paying higher capital gains. Let's talk about risks. First up is leverage. It's a double-edged sword. Yes, it can boost and amplify returns when the times are good, but when the times are bad, it can hurt you just as bad. Then there's sector concentration. As you've seen, the mix is heavily focused on tech, fintech, crypto-related stocks, and if the market swings or when the market swings, that can also really hurt you. It's a very volatile sector. Also, a covered call strategy caps your upside. When the market goes up, those call options that were sold force the ETF to sell its shares, the underlying shares, at a predetermined price. For example, let's say a covered call option was sold at a $25 strike price, but that stock goes to $100. The ETF has to sell that share not at the $100, but at the $25. That means you miss out on those huge gains beyond that strike price. And another key risk is what we've already talked about, return of capital. It might indicate that the fund isn't bringing enough options premium or dividends to cover its payout. And this could potentially erode your capital over time if it's not offset by that significant growth. As you can see, this ETF is not for the faint of heart, and especially not for beginners. So, having said that, who is this ETF designed for? Honestly, in my opinion, this ETF is designed for ultra-aggressive income seekers who are willing to tolerate substantial volatility and who fully understand the risks around how leverage work, how covered call options work, and how return of capital impacts your distribution and taxes. However, if you're planning for retirement or you prefer a more steady, conservative approach for investing, this ETF is not for you. It's a high-risk, high-reward ETF. But if you still have that itch to scratch because you can't get away from that monster yield advertising, then only make this a very small speculative slice of your diversified portfolio. Definitely do not make this a core holding. If HHIS feels way too wild for you, here are some alternative ETFs that you can consider for those who still want an income-oriented investment approach. For example, we have the Global X covered call funds such as QYLD if you have US access, or Canadian options like the Hamilton ETF's full suite of yield maximizer ETFs. They're all designed to give you like 10 to 15, 16% yield, but they've been around for a little bit longer, so you can see how the underlying ETF works and how those distributions play out. Or if you want a more traditional approach to Canadian high dividend ETFs, then you can consider options like VDY or XEI, two of my personal favorites. These two ETFs offer a more steadier and conventional approach to income and growth without the unnecessary complexities of ROC and covered calls or leverage. Remember, with monster yield comes monster risks. Balance the potential for income generation for potential losses, and look beyond the yield that's advertised to understand how the income is actually generated. All right, folks, I got a question for you. Knowing all the risks we've talked about on this ETF, would you drop in right now a cool $1,000 on HHIS? Let me know your thoughts in the comment section down below. And if you have questions around covered calls or how ROC works, again, just drop me a note in the comment section down below. I'd love to hear from you. If today's deep dive on HHIS and how ETF distributions work open up your eyes, then make sure you hit that like and subscribe button. It also lets me know what type of content you want to see, so that's the content I can make next. And before you go, make sure you check out the links in the description below for some great resources. That's it for now. I'll talk to you in the comments section.